This is Oracle's trading, your access to hidden trading knowledge. We are going to be giving you a very simple but very profitable trading technique. In 2026 and onward, this technique is going to make you good money. You are going to be enjoying your trading as long as you exercise discipline and stick strictly to our recommendation. You are going to be surprised how simple trading is, but your discipline, patience is going to guarantee your profitability. So number one, we are going to insert oscillator MACD. There are different MACD settings, but we are going to be introducing you to the default setting. The fast EMA is 12, slow EMA is 26, and the MACD SMA is 9. This is going to be applied to close, and then let us choose our colors. And then our line thickness. Let us make it a little thick for the purpose of trading. So please take note of these settings. In case you forget the settings, what you just come to do is to reset the settings. And then here we can say OK. Let me reset the setting. I don't want this to be dotted lines. I want it to be continuous line. If you are used to trading, you may think you are familiar with this technique. If you are not still making profit, it means that most likely you don't know how to use it. So we are going to be combining this technique with some other trading techniques for you to maximize profit henceforth. This is MACD, moving average convergence divergence. It is a very, very powerful indicator. It is a momentum indicator. That means it helps to measure the momentum of the market. This indicator, is on the trading chart of most professional traders. They just have it there. It gives a lot of information to the trader, but many traders do not know how to use it. Now, let me explain briefly now how this momentum indicator works. At this level, the 0 point, looking at this window now, the MACD window, we have here 0.00 mark or level. So that level is a very, very important level. It is crucial. And what you have, all this green that looks like rectangle, are called MACD histogram. And the red line is called the MACD signal line. Where many people fail in this technique is that they just take the histogram crossover and trade it. It can be good, but you can do better than that with this training. And don't forget, the problem of most traders is impatience, inadequate knowledge, impatience. So, the simple application of this technique is that once the histogram bars are forming above, these are the histogram bars, the green rectangles that you are seeing, that the histogram bars. Once they are forming above the 0.00 mark, the market is said to be in uptrend. And when they are forming below the 0.00 level, the market is said to be downtrend. That is the basic application of the technique. But it is much more than that. If you want to further refine that, you wait till the signal line also crosses. Many people just use only the histogram bars. They don't wait for the signal line, which is the red line, to also cross down. So for instance, now, if at the basic level, if a trader wants to use this technique, he wants to sell not only when you have the first histogram crossover, that is crossover of the 0.00 level. No, once this one crosses over, it's like on your mark, and then you wait till the signal line, the red line now, crosses the 0.00 level. That is like get set and go. Yet that is not how we are going to be applying this technique, because we want to combine it with other techniques to get the best out of it. Because successful trading is not only on your entries. In fact, professional traders know that your exit is far more important than your entry. In aviation, it is said that landing is much more important than taking off. Anybody can take off, sort of, but not anybody can land a plane. So that is very much applicable to trading. It is easier to enter than to exit the market. So this simple technique or trading system is going to help you to maximize your profit henceforth. If you are seeing this, if you are watching this video, you are one of the lucky ones. Only make sure that you do exactly what we say you should do. So once the histogram bars are forming below the 0.00 level and the signal line, the MACD signal line, is also below the 0.00 level, then the market is said to be downtrend. As I said earlier, we are still going to filter that. The reverse is the case. If both the MACD histogram and the MACD signal line are above the 0.00 level, we consider the market to be in uptrend. But that does not mean you should buy. We are going to be telling you in no time when exactly to buy and when to exit. So now let us take this area for example. Over here, this is the first MACD histogram to become positive. If you place your mouse on the histogram, you see that it is positive. This is where some traders enter. Once they see that this is positive, they go to the corresponding bar or candlestick and then they buy the high of that bar after the candlestick has completed its formation. But we are not going to be doing that. So for a more advanced trader, he's going to wait till the signal bar crosses. That is till the signal, till the signal line, the red line now, in this case, becomes also positive. That means it has crossed the 0.00 level upwards. So once a more advanced trader is going to wait for this to happen before he press the trigger. Yet a more advanced trader than that is going to use other indicators to confirm his entries. It's not just going to enter here. So one of the indicators we are going to be using to confirm the uptrend is exponential moving average 240. Okay, let us insert that and see. Insert indicator moving average period 240. You may not be used to this period, that is period 240, but you are going to see what it does now. Some people use period 200. That is up to you, but in our case, we use period 240. See, for you to set yourself apart, you must discover something in trading that the majority, the masses, do not know. So I think this is cool. Let me change this to this color. Sorry, I prefer orange. I prefer my 240 to be orange. And then say, okay, this is wonderful. This is wonderful. Now, how does this moving average works? The exponential moving average 240. It is simple. Once you have 4 completely formed candlesticks below the exponential moving average 240, it means that the market is downtrend. It doesn't mean that you should sell. Please take note of that. We are looking for 4 candlestick formation, at least 3, but 4 preferably. So in this case, we see the market coming down, and it crosses below the exponential moving average 240. But fortunately or unfortunately, only one candlestick formed completely below the moving average. So we are still technically in an uptrend according to our trading technique or methodology. Now, once this happens, we consider the market to be in a neutral state, but predominantly uptrend. Now, we are looking for candlesticks that will not touch. We are looking for candlestick that will not touch the exponential moving average at all. We don't want the wick or any part of the candlestick to touch it. Now, the market shifts position and moved up again. Now, it is now moving away from the moving average, and we see that 4 candlesticks, 1, 2, 3, 4, now formed above the exponential moving average 240. That means that we are practically in uptrend now, but it doesn't mean that you should buy. It means that in your mentality, we are uptrend. The market came down and touches the moving average here at this point. So we are going to neutralize the fall that formed, because now touching it is that we are not sure of the direction of the market again. So we want confirmation. We want to be sure. And then the market took off in the up direction again, and we have 4 formation that did not touch the exponential moving average 240. So that means we are in uptrend, but it doesn't mean that we should buy. We are going to wait for our trigger. Now, when are we going to buy? we are going to be using the MACD. Excuse me, we are going to be using the MACD to buy. Now, if you look at the MACD, we want the MACD to be in concordance with the EMA 240. So at this point, at this from here, from this candlestick, this particular candlestick, we see that the market is uptrend. And then from here, from this level, we see from this particular candlestick, the MACD histogram is saying that the market is uptrend. This is exactly what we want. So the MACD and the exponential moving average 240 are speaking the same language now. They are beating the same drum. We want to flow with them. Do not forget, we want at least 4 candlestick formation to be above the exponential moving average 240 for us to consider the market to be uptrend. And then we also want the MACD histogram and the MACD signal line to be above the 0.00 level for us to consider the market uptrend, and then we're ready to take our trades. Now, where do we enter? We are going to drop down to the MACD and then trade what we call pullback. Here, the market advanced above the EMA 240. The market advanced considering the MACD histogram also. So we're going to be waiting for a pullback, and the pullback, we see it here. That pullback we are waiting for is going to be determined by the MACD, not necessarily by looking at the candlesticks formation. So here we see that the histograms are above the signal line. So we wait until at least one of the histogram bar closes below the histogram, closes below the signal line, which is this particular candlestick now. It closes below the signal line. That is, as far as we are concerned, that is pullback. The pullback does not have to be significant. All we just want is for a histogram bar to drop below the red line, that is the signal line of the MACD. So the condition is fulfilled here, and once it is fulfilled now, we now begin to wait for the first histogram bar that will close above the signal line, which, if we keep coming, this particular histogram bar meets that condition. Therefore, once we get a condition like this, we don't waste time, and this candlestick above the EMA 240 closes. The next thing we do is that we buy above this candlestick that corresponds to the first candlestick that closes above the signal line, the MACD signal line, after this drop. Remember that when the market is pulling back, we don't want it to pull back below the 0.00 level. So if the MACD histogram is pulling back, or the market pulling back, we don't want these histogram bars to become negative, to go below the 0.00 level. Here it didn't happen like that. And then excuse me please. So at this point, the high of this candlestick plus 3 or 5 pips is our trigger. We buy there, we buy, let's say at this point, and then look at the market going. Let me see. So we see the market moving, going and going and going. This is just beautiful. Now, as the market was going, that is momentum. We want to trade momentum. That is what we want to do in a strong trend. So here, the EMA 240 has indicated to us that the trend of the market is strong, and the MACD has also shown us that the market is strong. So we follow the momentum of the market. As long as the histogram bars are above the MACD signal line, the momentum of the market is strong. So you just keep going. Now, for capital preservation, if any of the histogram bars drops below the signal line, we consider that the first one may be a mistake. It is possible it is a mistake, but the second one, so the first one, it is good to exit in the first one because you are preserving your capital. The second one is better because it gives the market a little breathing space. Then the third one, that is below the signal line, is good. That is in an uptrend. You should exit. You shouldn't wait for more than 3 bars, MACD bars, histogram bars to fall below the MACD signal line for you to exit. You can exit the first one, or you wait for the second one, at most the third one. That is good, better, best exit. The first one is good exit, the second one is better exit, the third one is best exit for capital preservation. So in our case here, for you to actually know, let me mention quickly, here we have our data window. For you to, this is how you add your data window. Let me close this and add it again. This is closed. And then let me insert. No, it's not going to be insert. I'm going to go to view. I'm using MetaTrader 5, please. View data window. Just click it, that's all. Everything comes here. So anywhere, once you place your candlestick, your cursor, your mouse, when you place your mouse on a particular candlestick, you are going to see the characteristic of that candlestick on the data window. We are using, the time frame we are using here is 4-hour time frame. It works for any time frame. It works for any time frame. So at this point, when you enter here, with what I'm seeing here, you are already making over 250 pips. And then we have not, okay. So at this point, let us look from here now. The momentum of the market is increasing, It has not dropped here, it has not dropped anywhere here. And then here it dropped 1, 2, 3. 1, 2, 3. So the lowest of the 3 drops, minus 5 pips. Minus 5 pips is your exit. So here we have 157.63. So it's going to be 157.52 to be taken out. And this particular candlestick didn't meet that condition. So we are still in the market. And then after this drop, and we have another momentum histogram. That is the first histogram now to close above the signal line. We also enter again. That is your add-on. That means the market is very, very strong. So you keep going and keep going and keep going till the market permits you to exit. So we are going to leave you with that exit strategy for now. We are going to be having advanced training on this, where we are going to be introducing you, where we are going to be introducing you to other exit techniques. And then you can apply this technique the same way to the downside. That is, if you are selling, let us look for a portion like that, and then we bring the training to a close. Okay, here we have the market. So first of all, you are going to be looking at what the EMA 240 is saying. Here we have 4 candlesticks, 1, 2, 3, 4, forming below the EMA 240. Our MACD histogram is perfect, telling us that the trend of the market is down. But where are we going to enter? We are going to wait for a pullback first. This is the first one, the first down move. The first down move. Here we have the crossover. So this is the first down move of the market. So we're going to wait for a pullback. We're going to wait for the market to pull back here. So when the market actually pulled back, So, but when the market pulled back, it touched the EMA 240. So it nullified the down move. So we are going to be waiting for another set of 4 candlesticks forming below the EMA 240. 1, 2, 3, 4. We got it here. We got it here again. But that is 1, 2, 3, 4. But we're not going to be selling, though opportunity arose here. But at this point, we have not had our 4 candlesticks below the EMA 240. So we wait for a pullback again. The market pushed down here, and then here we wait for a pullback in the histogram, because that is the one we are going to be using as our trigger. Yes, now the histogram pulled back to the market pulled back, but didn't touch the histogram bar here. Sorry, didn't touch the EMA 240, which is what we want. So the histogram pulled back. So we will now wait for when the histogram bar is going to close now below the signal bar, because we are looking to sell. We are going to be waiting for the histogram bar that will close below the MACD signal line. So that is what is going to give us our signal, and it is going to be the first one that will do that. So let us move forward step by step. Yes, I think we got that here. We got that here on this candlestick. So we're going to sell. We're going to sell here. Now, when you sell here, where will your initial stop loss be? Your initial stop loss, just make sure it is above the EMA 240. You can put it somewhere here. You can even put it as very far away. Put it far away, please. Somewhere here. In our subsequent videos, we are going to be introducing you to detailed regions where you can set your stop loss. But for now, it is safe if you just set it above the signal, the EMA 240. Just use any of these swing high. That is, swing high is a place like this, that's swing high. Later we're going to be working more on that with you. So we sell here. We sell. Let me remove this one not to confuse us. we sell at this point, our stop loss is above the initial protective stop. That is what it is called among the professionals. Initial protective stop. Remember that in our training we said that we don't call it stop loss, but for the purpose of understanding, I'll still be calling it stop loss for you. So, but we call it stop, protective stop. So, but the first one you said is at this point initial protective stop. And don't worry, this is one of the problems why traders lose, because they stay too close to the market. You are going to lose that trade. Allow the market to breathe. Give the market enough room to breathe. Don't be afraid. If you are scared of trading, then perhaps you shouldn't be in the business. If the pilot is afraid of flying, he shouldn't be a pilot. Not everybody should be trading. Not everybody should be trading. If your system does not permit you to trade, then just keep off. Let those that can handle the market be there, and then you look for another business to do. But if you are going to be faithful and just stick to the technique, don't be afraid of how you're going to enter, of what you are going to lose. As long as your trade is 1%, your stop loss is 1% of your trade, or sorry, all your trade is risking only 1%. There is nothing to be afraid of. If you lose 1% of your capital, it doesn't shake you, and you can easily recover it with this technique. This is optimized trading strategy. So let us see what the market did here. We are going to we want to exit as quickly as possible. That is by using those 3 MACD histogram that drops below, in this case, below the signal line. You can use the first one. It is good because we want to preserve capital. You can use the second one. You can use the third one. We said it is good, better, best. So we continue. The market kept going, just kept going down. This is so sweet. This is so sweet. Now, this is it now. So we're triggered here. At the time, we were making over 400 pips. Over 400 pips. That is trading 4 hours. So what happens now? We wait. The market advanced and we made some pips here. Sorry, I'm using pips, not really money, because true professionals count their profits in pips, in points, not in terms of money. Because you can have a trader that is very sound, but he doesn't have the capital to trade big. He may not have the capital to trade big. And so it is not the amount of money that you make out of the market that determines how good you are. You can meet somebody that doesn't have anything near the capital you have and is better than you. So in a case like that, you calm down to learn. So the market retraced here. So we have the first one, 1, 2, 3. So the highest of them all, that's where you come out. You just pull out of that place. So we're going to be exiting the market here, because this is the first one, 1, 2, 3. So we exit the market. This candlestick took us out. Exit the market, please. It's capital preservation. This is the problem with traders. Now, at a time, he was making over 400 pips. Now, at this point, he's making like 190 something pips. So he's going to be angry with himself in most cases. Which is it not good? Just take it. As long as you are not coming out with a loss, just take it. It is good, and look for another opportunity. Because if you don't take it, you can lose everything to the market and more. All your profit can be lost to the market, and the market begin to chop into your capital. Actually, before you get here, in a separate video, we are going to be talking about how you take your profit. How you take your profit. So each signal that you have, you should place 3 trades. And if you should lose all the 3 trades, you shouldn't lose more than 1% of your capital. In one of our videos, we did that. We may still need to do another video to emphasize that. Any comments you have, drop in the comment section, and we will be there to answer your questions. So now we are out of this market here, making about, let's say, 180 pips, which is good. You know what that translates to if you are trading standard lot size. So let us continue. Whether the market is going to allow us to continue downwards or the market is going to change direction, we don't know, because this histogram bar has dropped below the signal bar. So we are going to be waiting. If this histogram bar now closes below or drops below the signal bar, now we are going to sell, because the MACD the EMA 240 is still telling us that the market is downtrend. Yes, MACD histogram is telling us that the market is downtrend, but we are not permitted to enter yet until we receive that signal from the histogram bar dropping below the signal bar. So we keep going, we keep going, we keep going. Yes, this one meets the condition, this particular candlestick. Let me rearrange these candlesticks now. Let me close all these ones now because we're going fresh now. So this particular candlestick, this one, is telling us that, okay, we are good to go now, because its histogram bar dropped below the signal bar. And then we said that, okay, just put your initial risk, put it anywhere above the MACD, above the EMA 200. Why we are doing that is that before the market will get there, the market will have given us opportunity to exit, most likely. And wherever you are putting your stop loss, it should not be more than 1% of your account if you should lose that trade. So let's keep going. Let us keep going. Market dropped. It kept going. That is momentum. That is what we want. It's going down. It's still going. It's still going. This is sweet. And for your information, this chart we are using to, or I am using to show you this technique, was not premeditated. It is once I started making the video that I just jumped here. It wasn't premeditated. So we keep going. You should backtest this technique and see for yourself before you begin to apply, please. Backtest properly and be comfortable with it. Backtest, demo trade before you apply on real account. You are going to enjoy trading henceforth. Now, the market came down so smoothly. It was so smooth, and it may not always be like that. Please do know we are using 4 hours. This one moved about how many pips? This is like this is over 1,000 pips. Over 1,000 pips. You know what that means in trading. And you are still inside. Many will rush outside. Yes, it is good. If you decide to do that, that's on your own. But we are going to be telling you where to exit, where to take partial profit. Every signal you get, you place 3 trades. 3 trades. So you are going to take profit on 2 before you apply these 3 histogram bars forming above. Now here they form above the MACD signal line. So this is the first one that forms. We go the second one, because they are above now, telling us that though the market is downtrend, but at the moment the market is resting. It is taking its rest. Then the third one, 1, 2, 3. The highest of the three is where we place our stop loss. That is subsequent. We call this one subsequent stop loss. So put it here. So because we are trading momentum at the formation of these three, we no longer trust the momentum of the market. So at first, the market that was making over 1,000 pips, now where we want to exit is making about, this is about 550 pips, about 580 something pips now. 580 something pips. You know, it is very painful to the trader. How will I lose half of my earnings to the market? It's not palatable. So actually, before we got to this point, I saw something here. There was a drop here, but it was just one candlestick, and then the market continued. So at this point, we would have entered another one. That is, at this point, we would have entered another trade like that. So we place, that said, we place our stop loss here and see what the market wants to do next. Is it going to go down? The market decided to move up and take us out. So we are going out with about 500, over 500 pips with no losses. Let's keep going. The market is still downtrend. Don't forget the MACD. The market is still downtrend. Let me remove all these ones now. Why is it still downtrend? Because the EMA 240 is still saying it is down. The MACD is still saying it is down. Now, MACD histogram, one of MACD histogram have crossed to the upside, meaning that the market is no longer downtrend. We no longer trust the direction of the market. So at this point, you don't do anything. Let's keep going. So MACD histogram, MACD and the EMA 240 are no longer singing the same song. So we keep off from this market. We keep off. Just keep off. We're waiting for when they'll be singing the same song. Yes. Now, at this point, the MACD decided to go downtrend again. That is at this point. So we're going to wait for a pullback here now. We pull back before we decide to sell. Yes, at this point, we have the pullback. So here the market has advanced downward at this point, because there is crossover here of both the histogram bar and the signal bar. Let's see, we are moving this candlestick one bar by bar. Let's see, now this one has closed below, so we're going to continue our down move here if our trade is triggered. The market, let's see, is triggered, and the market kept going down. It's going up now. Now the market took us in and it started coming here. It started retracing backwards. I'm going to tell us something about this candlestick that took us in, but that is going to be in a more advanced video, in a more advanced class rather. So we are going to wait for these three pullbacks. If we get three pullbacks, we're going to be coming out of that market. But we didn't have it. This is 1, 2, 3. Yes, our stop loss would have been here. You know, the initials, our stop loss would have been here. At first, we entered here, we were risking over 500 pips. The beginner trader, the average trader, the struggling trader can never risk that amount. He will rather not take that trade than risk that amount. Remember that here the EMA 240 pips is even far away. So meaning that the trend is very, very strong. And here you cannot even move your stop loss above it. Even if you did, it doesn't matter to us. What matter is this subsequent stop loss, because we know the market is going to give us opportunity to reduce that stop loss. So we now reduce the stop loss here. Now the market is going back. And the market took us out here. So we bear that, and considering what the market has given to us, this is nothing. So it's not that the technique is void of losses, but you can imagine how the market kept you out of the ranging markets or markets that are going nowhere, and then how it helped you to join the profitable moves. So it took us out here, but we are still downtrend. We are still downtrend. So we come here again because the market has given opportunity. This is the first advance. We are not going to enter there. We wait for pullback, and this is the pullback. This is the pullback, and then we're going to wait for continuation. So this is the continuation, this candlestick. Now we sell here and watch what the market will do. The market took us in, formed the three opportunities to exit. Our exit will have been here, and of course when we entered here, our stop loss is going to be somewhere here. We want to be far away from the market. Actually, we'll be risking over 600 pips, but with this we have reduced that to about 200 and something pips. So the market keeps going. And then at this point again, 1, 2, 3 here, we reduce the stop loss here again, and then we'd have taken some profits down here as the market was going down. So here again we come out. The last trade is going to come out with a little loss, less than 40 pips. But at a point you made over 100 pips here, over 150 pips. Over 150 pips. So this is the technique for you. Enjoy the technique and make your money. This is Oracle's Trading. If you have not subscribed to the channel, do so, like it and share the videos. Comment on the comment section and watch it over and over. You can download the video, play it over and over till you grasp the concept, backtest it, demo trade it before you apply to real account. Thank you.